All right, next let's look at ratio analysis. Ratios are quantitative indicators of financial strength and operating success. So the figures used in calculating ratios come from various financial statements, like balance sheets and income statements. Lenders will be most concerned with ratios that indicate the degree of risk associated with extending credit to the business or agency. Potential equity investors will be more concerned with the return on investment indicators if somebody's going to invest in your business idea. Okay, so liquidity ratios. They're also called solvency ratios. They indicate the ability of a business to meet its short-term obligations. Then we can also look at activity ratios, which are sometimes called efficiency ratios, and they're quantitative indicators of the ability of the business to expediently and efficiently exchange its products for financial resources. So how fast they can become liquid. So if we look at profitability ratios, they show how successful your business or agency has been during a certain period of time. So, and this is terms of investment returns. And they're usually over a year, so a fiscal year or a calendar year. We can look at debt coverage and leverage ratios to measure the long-term solvency of the business as well. But again, these are looking at the ability for a business to turn a profit or to increase revenue. So one liquidity ratio is called the quick ratio, and it's used to estimate the ability of a business to meet its short-term financial obligations without selling any inventory. So overall, an easy way to look at this is our quick ratio is our current assets minus our inventories divided by our current liabilities. And that'll just give you a quick and easy quick ratio. So another one we can look at is the debt to net worth ratio. And this is used to compare the total financial obligations of the business to the investment of its owners. So this is used by lenders as a measure of risk. So if they're going to extend credit to the business, they want to see what risk there is regarding this. And again, we can look at this as the debt to net worth ratio is equal to the current and long-term liabilities divided by the net worth. All right, so the final one we'll go over here real quick is the current liability to net worth ratio. This is just another measure of the short-term risk associated with lending resources or making a loan to a business. And this is really the current liabilities divided by the net worth. So how much do we owe outstanding in all areas divided by how much we're worth altogether.